Ready to do the show?
Change them and chase the strength.
Hello, everyone. And today we are talking about changes. Changes that are coming to the Fannie Mae world and the mortgage world. But we have to do it this way. This is Barry Bowie, because when we play the real David Bowie, YouTube just yanks us like the tiniest, bittiest little tiny thing. And they're going to pull us out. So, welcome to the Barry Bowie Show. Way better than David Bowie.
I'm sorry. What's that?
We're good. Say hi.
Hi.
It's you. It's you. Hi, everyone. Welcome to Moving Forward TV. I am Delynn Gaston. We're starting the show.
Hey.
And this is Barry Bowie.
Hello, everybody. My name is Barry Horvath, and this is Barry Bowie TV.
That's right.
Thanks for watching, everybody.
Moving Forward TV. Thanks for joining us. So,
Just kidding.
how much fun was that? So
It
he
was so
really
much
does
fun.
know how to play. And he really does do much better than that. But
I got my, it's my Fender Squire, and it's signed by none other.
Joe Vera.
Joe Vera signed it, and there's her little logo right there for all you fans out there. So, how cool is that, huh?
I know.
So we're going to talk about David Bowie and changes.
Changes.
So I love that song. Just
I know, it is good. I know, especially being you've been like playing it all morning in your ears, right?
I love it, and it's really cool through my
I know.
earset. So do the show, and I'm going to listen to some more Bowie. Let me know when it's over, okay?
Yeah, we'll do that.
Oh.
Anyway, so
Back in the saddle.
back in reality, I know. So Barry Bowie is not,
He's not a
like
real
pulling
person.
in the millions,
Dang it.
being a cover for David Bowie.
No.
But you could. You
I
could.
probably could. Actually, our good friend Eric Anderson does a David Bowie tribute band, and they are excellent. You haven't
No
seen them? There's a
kidding.
plug for you, Eric. I know you're out there. So
If you haven't seen Eric Anderson, he really is phenomenal. He plays at
awesome.
a lot of the local
Awesome.
places, Gill Dogs and Brass Tap and things
right.
like that. He's very, very good. So you guys got to catch him.
So
Anyway.
we're going to talk about some major changes that are effective on the 29th of July, and some credit changes that actually already in place.
Right.
And all of you buyers, sellers out there, real estate professionals, know that we're all about notifying you changes, and it affects your business, your paycheck, the dream of home ownership. And
Right.
It impacts you. And we went through that cycle where things were really slow and
Right.
bad, and now things are crazy. But it's kind of funny, some of the guidelines, and we're going to go over them with you, are actually kind of loosening up.
Right. So a lot of people have been complaining for years now that, it's so hard to buy a house, it's so hard to buy a house. Well, you have to qualify. You can no longer just, okay, you have
can't
a
do the
post.
fog on the mirror.
Yeah, I know. And you need a little bit more than that. You need to actually qualify for the loan. And so people were saying, but it's so hard, but it's so hard. Well, Fannie Mae is actually starting to loosen up. Although I think you have a really good perspective on why Fannie Mae is loosening
Well, I'm going
up.
to tell you why. Here's the reality. It's business. And
Right.
businesses are competitive. And FHA, way back in the mid-2000s, FHA loans, people would run away from them because of
Right.
the requirements, because of the inspections, because we're like, you can't go FHA because you'll never close. That was, remember the stigma
Right.
about
So
that.
FHA loosened up a little bit.
FHA loosened up their guidelines. They allowed higher debt ratios,
Mm-hmm.
and the government guaranteed the loan, so the lenders were more likely to give you an FHA loan. Well, guess what happened? People shifted. Subprime went away. FHA became the new subprime.
Right.
And now FHA is really booming with business. So Fannie Mae and Freddie Mac says, we need some more business. We're losing it out. Where's it going? FHA's getting it. So
Even good, FHA has always been, like Barry said, higher debt ratios and sometimes lower credit scores too, because FHA isn't as concerned with credit scores. They definitely are more lenient when it comes to credit blips or late payments or collection account or something like that. Definitely more lenient than Fannie Mae or Freddie Mac had been. So Fannie Mae and Freddie Mac were losing business. They were absolutely, because things weren't fitting, so people were putting everybody into FHA. All of a sudden, FHA's business is huge.
It is. So let's talk about some of the big changes that are coming into play right now. So you know what?
Fannie Mae changes, not Freddie Mac yet, but Fannie Mae is making some major steps in changes.
So I always like to tell people, maybe you tried to get a loan a while ago, and it didn't work out for whatever reason. You might want to look at it again, because every day things change.
Always.
The only promise.
Thus our show, moving forward.
Yeah,
it is an ever-changing industry these days.
I thought it was the Barry Bowie show.
It's not the Barry Bowie show. Today's show can be the Barry Bowie show if it makes you feel better. But it's really
I really liked rocking out more than guidelines. I'm just going to say.
I know that part was fun. You can rock out like maybe between and during the commercial breaks.
All right, so let's talk about the first big thing that's on the Fannie Mae changes.
Debt ratio.
Debt ratio. You know what? One of the biggest challenges that people have is qualifying for a loan because they have a high debt ratio. And remember, debt ratios include your new mortgage payment, taxes, insurance, car payments, student loans, credit cards, installment loans, HOA fees, and you know what people forget about? Co-signing. If they co-sign for a loan, those all go into your debt ratio.
Right.
And if the higher the debt ratio, the harder it is to get the loan.
Right.
So what have they done?
And one of the things a couple of years ago that they did that a lot of people got very upset with was the student loans. You mentioned in that debt ratio student loans. It used to be if your student loan was deferred, we didn't have to count it into your debt ratio.
Wow.
That changed.
You just moved right up to number 4, didn't you?
No, I didn't. No, I'm still on debt ratio.
Okay.
What my point is that remember when they made that change and everyone, it was like, wait a minute, even if it's deferred, you have to count a payment now.
Yeah.
So that made everyone's debt ratio go higher, which, to your point, made people not qualify anymore to buy a house because even though this student loan is deferred and you're still in school and you got another 2 years or whatever it is, we still had to take a payment into, and we still do, but with the expanded debt ratios now, Fannie Mae is allowing us to go up to 50%.
50%, which
That's
means
crazy.
Which means if you make $1,000 a month in simple math, your maximum debts on all those things I just mentioned to you would be $500. With all of your debts. So that's huge. That's such a positive change, though.
That's big.
For the industry.
Because, for those of you who don't know, it used to be 28 and 36%.
What she's saying is 28% on your ratios, your front end and your back end ratios. Yeah, we don't want to teach you how to be a loan originator because then we wouldn't have jobs. But, just to give you the gist of it, talk to your lender, find out if these changes can help you or not. So, go to somebody who's up to date on these things.
Yeah.
Hopefully. So, we've got several other big changes. The max 50% is just the tip of the iceberg. The other things are hopefully going to make your jobs easier and
more people qualify.
Yep. So we're going to tell you more about that right after this as I go write another song with David Bowie. We'll be right back. Excuse me.
That was cool.
Yeah, I wrote another song.
You are just so cool.
I'm just such a rock star.
Every man's dream, isn't it? Like,
Yeah.
to
And you know what stinks is my son lives it.
I know, and your son
Did
is
you see the crowds?
absolutely living it.
Yeah, so I
That's
know you
pretty
watch
cool.
the show, kid, but good for you. Congratulations to Jewel Vera
That's
for their
right.
successes.
And for anyone who doesn't know, look them up. They are an amazing up-and-coming band.
Yes, they are. Anyway, do you want to talk about mortgage
Yeah,
stuff?
so stuff. So
Because
the
the
other-
realtors really don't care about my rock star
But-
life.
I know.
They might, but I kind of doubt it.
All right, but we are about educating you, not only on the great and up-and-coming rock stars, but also on mortgage
Because
guidelines.
that's important. So, the big thing way back was, people fix their credit, because
Right.
part of qualifying for a loan is your credit score. And what people would do is they would dispute something that was bad, saying, no, that's not mine.
Right.
Remember?
And because what did that do? That took it out of your score.
Yes, it did.
If it's
So all of a
disputed,
sudden-
it's not in the score anymore.
All of a sudden, your 620 became a 660 because that doesn't count against your credit score. Well, you disputed it, and then the lenders would say, yeah, we're on to you. You're fabricating
doing
your
this.
score. You're giving us a false reading. And then we had to tell people, oh, you got to remove those disputes. Well, guess what, Delynn? What Barry Bowie learned today.
You don't have to remove them anymore.
No, that's pretty
Yay.
exciting. So people can actually go in, and if you have disputes on your credit report, you don't have to remove them.
providing we get approved eligible findings. So what that means in layman's terms, I think everybody knows by now.
Nobody
we run
knows.
in the mortgage world. Everybody does this. We run it through Fannie Mae, Freddie Mac, or whatever. So we would run it through Fannie Mae, which is called the DU system, an AUS, automated underwriting system. When we run it through the system, it comes back and it tells us if it's approved or not, if this is a loan for Fannie Mae or not. And on those, we call them findings, on those findings, it will tell us if we have to have those disputes removed or not. But what they're saying here is that in most cases, they're not going to require them
That's
to
pretty
be
cool.
removed.
Pretty
That's
cool.
very cool.
Another positive change in history. Okay,
Because
another
it
one.
would just be time consuming, quite frankly, for people to remove
Oh, I
those.
know,
It takes
'cause it-
forever, and you
yeah.
got to fight,
Then
and
you
with
got-
the credit bureaus.
then you
if
gotta
anyone's
do a
ever dealt with the credit bureaus, you know.
And then you got to try and do a rapid rescore
Oh,
and
it's
change
just-
it, get it
yeah,
updated.
it's crazy.
You know what? You wonder why
Very
there's delay in
time-consuming.
closings? Yeah, that's
Yeah.
part of it.
Yeah.
Let's talk about this. You know what? To our self-employed borrowers, this is great
That's
news
another
for
good
you.
one.
1-year tax returns is now a possibility. Okay, it used to be just Freddie Mac had that option.
Yep.
And I remember you would run findings, and it would be like, as soon as you put that somebody got any kind of commission, bam, it would trigger
2 years tax returns.
Didn't matter how good your credit was, how much you had in reserves in the
Yep.
bank and liquid
Self-employed
assets.
or
Yeah.
commission.
But now there is a good possibility you can get 1 year. Now, that's huge because let's just say in 2015, you didn't do so great. In 2016, you really rocked it.
Right.
We used to have to look back and average the 2 years. Now we're just going to look at 1 year.
And keep in mind, there will probably be other things that have to be in place. Like it might be have a certain credit score to make that work at the 1 year.
Yep.
Might have to be a certain LTV, down payment or whatever. So these are just we're just hitting the highlights of these programs. There will be other things as we get closer.
And it
that get
doesn't
released.
say that, it doesn't mean that you cannot be self-employed for 2 years. It didn't say that.
Right.
Which means we're only going to ask for income documentation for 1
Right.
year. So
Yeah.
don't think you can open a company.
I'm positive you will have to be.
Don't think you're going to open a company and not
Right.
have to prove that it's been in business
Correct.
for at least 2 years, because
Correct.
self-employed borrowers do require 2 years. So
Right.
another positive thing. So what about this property inspection waiver?
PIW.
So, yeah, there's more
This
about
is
this we
strange.
don't know than we do know, because back in, when things were collapsing, people were actually taking pictures of facades and getting an appraisal, per se, and it wasn't a real house, and it was a scam and all this, so.
Really?
Yeah.
I don't think I knew that one.
Oh, yeah.
Wow,
They
that's
would
crazy.
flip these houses. There was
So
no
let's tell
real
them what
property.
PIW means. PIW means property inspection waiver, which basically in layman's terms means no appraisal.
Right, so,
about
no
that?
appraisal, yeah, so you can actually do a property now without an appraisal with this inspection waiver.
Potentially.
Yes, so.
And again, when everything gets put into the system based upon all the other factors of the loan, and the system, for what it's worth, they do their own internal estimation because it comes back and it tells us if it thinks the property might be
Right.
high or low or whatever. And it might come back and say, no appraisal necessary on this particular
And we don't know if
purchase
it's
for this
going to apply
particular
to
loan.
refis only. Is it going to apply to the purchase
We don't
market?
know
We
yet.
don't know. And can you tweak it? Because remember when we were doing the HARP loans, you would go in and say, we think the value's this. If you put the right value in, you hit the magic zone, it would
Right.
say, oh, we'll waive the appraisal.
We'll waive the appraisal.
So, and don't think you're going to escape an appraisal fee because lenders are going to probably charge a PIW inspection
anyway,
fee
you're right.
to review it, but it won't be the cost of an appraisal.
Right.
It'll be a
Right.
lower amount, I'm sure, but
But
stay
again,
tuned.
Not every single file, but
Yep.
it's something that Fannie Mae is definitely putting in
All right,
place.
Delynn, this is your favorite because you love student loans.
The student loan, so a lot of people have these massive, doctors, lawyers, massive student loans. And as you know, on your tax returns, nothing is tax deductible anymore except mortgage interest. So they have these huge loans that are like a mortgage payment.
huge.
A mortgage payment, so they have their regular mortgage payment,
Sorry,
and then
I
they
had
have
to throw
another
that in.
$1,000 a month or whatever in student loans. None of that is tax deductible. So a lot of times they want to do a refinance and pay off their student loans. That's called a cash out refinance. And it's looked at in the mortgage world a little bit differently, a little bit stricter on underwriting, a little bit stricter on loan to value, things like that. It is no longer going to be considered a cash out.
That's
huge.
And why is that such a big deal? Because that's an adjustment to the program.
To the
Your
interest rate.
To the interest rate. Qualifications may be different.
Correct.
So
it could
loan to value
really-
could be different. So rate and term is totally different.
Right.
All right. Now, these are all great positive changes. We have one more that you're going to really want to hear about for those of you who are thinking about taking on another job and qualifying.
Oh, this one's really good.
Yeah, but we're not going to tell you about it till after this, so stay tuned. No, you're back. I'm leaving.
You're still Barry Bowieing.
I'm out of here. See y'all. Oh, I can't leave.
Yeah, he's not going to leave without his guitar. I know he's not going anywhere. Anyway, all right, so this is really cool. One of the really, really interesting things. So a lot of times, especially down here in Florida, we have...
I thought the Barry Bowie thing was all interesting. The
That was
mortgage
very
stuff is kind of lame. Sorry. I know it's important that we know this, but it's still lame.
I know, you're right. You're right. It
So-
is. But this one is actually really cool. So down here in Florida, we have a lot of people who move in from out of state. They get transferred or something like that.
Glenn, the only thing cool about the mortgage industry is us. Okay? There's nothing cool about the mortgage industry.
Okay, I would agree with you on that.
So
I know,
quit
I'm
trying
such a
to
geek that I actually find this stuff cool.
All right, listen, quit trying to convince our viewers that the mortgage industry is cool, because it's not.
I know,
Otherwise, all of you would be
boring.
doing it.
Boring, it's hard, it's difficult, but some new cool stuff.
All right, go ahead. Tell them about this stuff, because the
All right.
show's almost over.
Okay, so like I said, a lot of people move to Florida, like 900 and something a day, I think the travel stats are. Move to
Did you get
Florida.
that from
so
AAA?
yeah. So they come in,
Yeah.
so they come to Florida and they might be transferred, or maybe they're here already and they're changing jobs. All of you realtors out there, I'm sure you've all run into this at one time or another. They change jobs, they haven't started a new job yet. And what does your mortgage person tell you? Oh, they need 30 days of pay stubs, or they need, a couple of pay stubs or something like that before we can close the loan. Not anymore. Can you believe that? Actually, 0 years, 0 months on the job. If somebody has an employment letter saying that I am starting on October 1st or whatever it is, when we run the findings, if it doesn't say have a pay stub, we don't need it. So they don't even have to start their job.
So what you're telling me is we can qualify somebody based on them even prior to starting a new job.
Yes. How cool is
Wow.
that?
Wow.
That's huge.
It might as well be stated income.
This has never happened in the
No,
industry.
we've never heard
all
that.
our 100 years combined.
That's
here
probably
that we've
one
been
of the
doing
biggest
this.
things
Yeah.
out. So, stay tuned, because we'll give you more details how exactly it's all going to work.
Right.
And remember, all these guidelines are Fannie Mae. Every lender that you deal with out there in the universe still can put their own overlays on what they feel
Right.
comfortable with. Sometimes they
They
don't
don't
like
have
it.
to follow these
Yes.
guidelines.
Now,
They don't have
Fannie
to.
Mae offers it. And again, you need to check with your lender to see if they do, because they might say no. Because a lot of lenders, and Dylan and I have been doing this forever, we've dealt with many lenders and banks, and they put overlays where they say, yeah, we'll do it that way, but we won't, even
Right.
though Fannie Mae may or may not buy it. They don't
Right.
want the risk.
For example, the
associated with it.
50% debt ratio. They might say that's fine that Fannie Mae will buy that.
Yeah.
We're not going to
Yep.
do that. We don't want our bank to be in that risk.
Right, so check with your lender, for specific. Now, one more thing we want to cover before we wrap up is
Can't say
timeshares.
timeshares.
Yes, so what does that mean on timeshares? Since you're a proud timeshare owner, and I'm not.
Interestingly enough, so in the world of timeshares,
Again, she's going to try and convince you that it's interesting. All right, go ahead.
timeshares on a credit report have always been listed as a mortgage. So when it reports as a mortgage, mortgages are very impactful to your score. So if you're paying your timeshare on time, that's actually boosted your credit score. If you're not paying your timeshare on time, because a lot of people say, it's a timeshare and I want to get rid of it, so they stop paying it, that hurts as much as a late payment on your mortgage. So just keep that in mind. It has always been treated as a mortgage on credit. Guess what? Not anymore.
Well,
now it is going to be treated as an installment loan,
and do you
just
think-
like a car loan or a furniture
I
loan.
find that positive, because a lot of people are willing. Oh, drink water. That's our alarm.
Sorry, it's my alarm.
Anyway, I think you totally made me forget about what we were talking about.
Installment loan versus
Yeah,
mortgage
so-
on timeshare.
No, I mean, I think people are more likely to walk away from a timeshare and not pay on it, and it can impact them. So,
I
but
know.
then the other side of the coin is somebody that's not had a mortgage but own a timeshare.
Right.
It may benefit them. So
Correct.
if you don't pay, maybe it's beneficial. If you do pay, it's
Right.
probably so.
Right.
That's just my take on it. But stay tuned for all of these things coming up, and we'll update you
All
as they're
these
going.
go into effect July 29th,
Yep, and
2017. So we
what
as
about-
lenders will find out a little
And
bit
we
more
didn't
as
even
it
talk
gets
about
closer.
the credit thing that is effective in July. The reporting.
You wanna
of-
mention that real
well,
quick?
Yeah, let's just
Yeah.
we'll just touch on it because we're out of time. But tax liens and
Can I take this call? It's actually
judgments.
my husband calling.
Yeah, go ahead. Say hi to your husband. Hi, John.
finish
run the
your
show.
tweet.
Tax liens.
Hey, we're in the middle of the show. Call you back. Bye.
Tax liens and judgments will no longer be reported on credit on all three bureaus. So go figure. So that's going to be an interesting thing. Now, foreclosures, short sales, and
That's still gonna
bankruptcies,
be-
that's still going to stick.
Right.
So now, that could affect the way approvals run again. So stay tuned. We'll get you more information on that as we see it happening. It's all these guidelines are in place, but when we act, we live, breathe, drink this stuff every day.
I know. So the moral of the story today is changes are always happening, like we've always said.
Changes!
Always happening in the mortgage world, and we are committed to keeping you abreast of all of those changes.
All right.
And we want to keep
wanna-
you informed.
All right,
it's
so-
all good stuff this time.
So
All
quick
wonderful
update,
stuff.
2 dates for you to keep in mind. August 11th, WPBA is doing the Rays bus trip. Starts out at Fiddler's Green.
And that's not sold out yet, right?
It's not. There's actually a few seats left. Go figure.
That's a really fun time if anyone hasn't been yet.
Press level seats between home plate and first base for about $40 for members,
Bring
$45
coolers
for
on the
9.
bus.
Go to WPBA.biz, book your seat now. And then Bowling for Boobs coming up September 26th. Breast Cancer Awareness Month coming up right behind it. So we're looking for local families to support with that. Great things in the community.
We're reaching out to the community as well. If you know people who could possibly benefit on our Bowling for Boobs, please let us know.
It's a great event. A lot of
It's a
fun. Men
wonderful
wear
event.
bras, and you're
At
allowed.
the very least, and food, we feed you. At the very
Yes.
least, you have to go and get some information. If you don't want to bowl, then come as a
And guess what?
spectator and help us raise
Carrabba's
funds
is bringing
for local
food this
people.
year. Yummy.
Carrabba's, thank you,
How exciting.
Carrabba's.
Port Richie
And
Carrabba's,
Port
you all
Richie,
rock.
Thank you.
All right, so get the show out, share
We're
it,
talking
like
faster
it.
because they're going like this behind the scenes.
Yeah. Facebook, Twitter, LinkedIn,
All that fun stuff. We
Twisty
appreciate-
Tumblr, whatever
we
else is out on
appreciate you
social
guys.
media. Share it. Tell your friends about us because we're crazy.
Thanks for watching. We are Today and Every Day.
Moving forward. See you next week. Barry Bowie rocks.
Bye-bye.
See ya.